In September of 2008, the global financial system was collapsing. Lehman Brothers had just failed. Merrill Lynch had been emergency sold. AIG needed a $200 billion government bailout. And in the middle of that catastrophe, one bank never posted a single quarterly loss. It didn't need a bailout. It didn't have to go hat in hand to the federal government. It came through the worst financial crisis in 80 years without breaking stride.
That bank was JPMorgan Chase, and the man running it was Jamie Dimon, who has now been CEO for 21 years and is, by most accounts, the most respected financial executive in the world.
I'm Hudson Thomas, this is Lana Chen, and you're listening to Charged Alpha, the S&P 500 Stock Encyclopedia, Episode 62. Today we go deep on JPMorgan Chase, ticker JPM.
The Fortress Bank. Let's dig in.
Let's start with a number that puts everything in perspective. $4.56 trillion. That is JPMorgan Chase's total assets, not market cap, assets. The company manages more money than the entire GDP of Japan. It is the largest bank in the United States by a significant margin and one of the largest globally.
The company traces its origins to 1799, when Aaron Burr, yes, that Aaron Burr, helped found the Bank of the Manhattan Company in New York. Over 225 years of acquisitions, mergers, and crises later, it became JPMorgan Chase & Co. The current structure really crystallized in 2004 when Bank One, under Dimon's leadership, merged with JPMorgan Chase.
Today, JPMorgan operates four distinct business segments: consumer and community banking, that's retail branches, deposits, mortgages, and credit cards. 316,000 employees serve 85 million consumer customers. Corporate and investment banking, this is the Wall Street half of the business. M&A advisory, IPO underwriting, trading, and markets. JPMorgan is ranked number 1 or number 2 globally in investment banking fees for 10 consecutive years. Commercial banking, loans and services to mid-market and large companies. And asset and wealth management, $7.1 trillion in assets under management.
The why now for this episode. Q1 2026 earnings are in 4 days, April 11th. This is the most watched earnings report in banking every quarter. Management has guided for mid to high teens investment banking fee growth for 2026, signaling that the M&A drought of 2023 and 2024 is finally ending. AI is already generating $2 billion in annual value, and the stock is 15% below its January high of $337.
Jamie Dimon. Let's spend some real time here, because Dimon might be the most consequential individual executive in American finance of the last 20 years.
He's 69 years old. Born in New York City, son of a stockbroker. He went to Tufts for undergrad, Harvard Business School for his MBA. He spent the first decade of his career as a protege of Sandy Weill, rising through American Express and then Citigroup as Weill built what was eventually the world's largest financial conglomerate. They had a falling out. Weill fired him from Citigroup in 1998.
That falling out turned out to be one of the luckiest breaks in corporate history, for Dimon and for JPMorgan. He took over Bank One in Chicago in 2000, turned it around in 3 years, merged it with JPMorgan Chase in 2004, and became CEO of the combined company in 2005.
He has now been CEO for 21 years. That's longer than any other CEO in the S&P 500 financial sector. During that time, JPMorgan went from being one of several major banks to being in a genuinely different category from everything else. Best-in-class ROE, best-in-class investment banking revenue, best-in-class technology infrastructure with a $17 billion annual tech budget.
What defines Dimon's leadership is his willingness to be contrarian and unpopular in service of long-term positioning. He famously kept building the investment bank when other banks were retreating. He raised reserves aggressively before every credit cycle turn. He wrote 17-page annual letters to shareholders warning about risks that most CEOs didn't want to discuss publicly.
The succession question is the most significant unresolved issue at JPMorgan right now. Dimon has said he has a few more years as CEO, maybe a few after as executive chairman. The board and investors are watching carefully. The financials for JPMorgan are outstanding by any benchmark. Total net revenue on a trailing basis, $179.4 billion. That's 5.2% growth year over year. Steady, not explosive, but this is a $180 billion company.
What are the key profitability metrics?
This is where JPMorgan truly separates from the pack. Return on equity, 17.8%. Return on tangible common equity, 19%. For a large bank at this scale, $4.5 trillion in assets, those are exceptional numbers. The peer average for major U.S. banks is around 11 to 12% ROE. JPMorgan is consistently 6 to 7 points higher.
What drives that outperformance?
Primarily two things. First, the investment banking franchise generates disproportionate fee income that has very high margins compared to traditional lending. Second, the efficiency ratio. JPMorgan runs at 52%, meaning 52 cents out of every revenue dollar goes to operating expenses. The industry average is closer to 60 cents. That 12-cent per dollar efficiency advantage on $180 billion of revenue is enormous in absolute terms.
The balance sheet?
Fortress by design. CET1 capital ratio of 15.1%. The regulatory minimum is around 10.5%. JPMorgan runs 4.5 points above that, giving management significant flexibility for capital return acquisitions or weathering credit stress. That excess capital is one of the key catalysts for the expected $25 to $30 billion buyback program in the second half of 2026. Overall, financial health, exceptional.
Analysts are bullish on JPMorgan. Of 26 analysts with formal ratings, 19 are buy, 6 are hold, 1 is sell. Median price target of $333, nearly 17% above current levels.
Goldman Sachs maintains a buy with a 350 target, calling JPMorgan's investment banking recovery the clearest earnings uplift story in large-cap financials for 2026. Morgan Stanley is overweight at 340. They specifically called out the AI program generating $2 billion in annual value as the most credible operating leverage story in banking. Barclays is overweight at 365, pointing to the CET1 cushion and expected buyback acceleration.
Q4 2025 earnings. What happened?
Strong. Revenue of $43.7 billion beat estimates. EPS of 4.81 was above consensus. Net interest income remained robust, and investment banking fees were up meaningfully from the prior year quarter. The market's reaction was relatively muted. The April 11th Q1 report is where eyes are focused right now.
And the macro backdrop?
Complicated. Tariff uncertainty has created both credit headwinds, borrowers in trade-exposed industries are under stress, and investment banking tailwinds. Companies rush to do deals before the regulatory and macro picture gets worse. The Fed cutting cycle is a modest net positive for credit quality, but slightly negative for net interest income. JPMorgan navigated 2025 well and is guiding confidently for 2026.
The bull case for JPMorgan is about what I'd call franchise value compounding. This company isn't just earning high returns today, it's building assets that create compounding advantages. The technology infrastructure Diamond has invested in, $17 billion a year, more than most banks' entire revenue, means JPMorgan processes transactions, detects fraud, manages risk, and advises clients better than any competitor. And that gap is widening.
The AI piece specifically is still in early innings. $2 billion in annual value from 450 deployed AI use cases. The company is targeting 1,000+ use cases by the end of 2026. If each use case averages similar value creation, which is conservative given scale effects, the operating leverage is substantial.
The investment banking recovery is the near-term catalyst. 2 years of M&A drought means there is a significant backlog of transactions, leveraged buyouts, public company mergers, IPOs, that are ready to close as rate certainty returns. JPMorgan's number one position in global IB means they take a disproportionate share of every deal that closes.
And the wealth management story is compelling for a different reason. It's structural. $84 trillion is expected to transfer from baby boomers to Generation X and millennials over the next 20 years. JPMorgan's $7.1 trillion AUM franchise is positioned to capture that generational transfer. This isn't a cyclical story, it's a 20-year demographic tailwind.
The bear case starts with the macro. If the tariff-driven economic slowdown turns into a genuine recession, credit losses spike across JPMorgan's consumer and commercial loan portfolios. The company has been building reserves, but a real credit cycle, auto loans, credit cards, commercial real estate, would compress earnings for multiple quarters.
Net interest income is another bear argument. JPMorgan guided for approximately $94 billion in NII for 2026. If the Fed cuts more aggressively than expected, say 4 to 6 cuts instead of 2 to 4, the spread income on deposits compresses, and that guidance becomes difficult to hit.
And then there's the Diamond premium. A meaningful portion of JP Morgan's valuation reflects confidence in one man's judgment. When Diamond eventually leaves, whether in 2 years or 5, there will be a transition discount. The succession is genuinely uncertain.
The regulatory environment is also persistently challenging. Proposals for credit card interest rate caps, Basel III capital requirements, and ongoing too-big-to-fail scrutiny all create headline risk that can weigh on the stock regardless of underlying business performance.
How does JP Morgan compare to its major bank peers, Bank of America, Goldman Sachs, and Wells Fargo?
Start with the ROE comparison because it tells the most important story. JP Morgan at 17.8% ROE versus Bank of America at roughly 10% and Wells Fargo at 12%. Goldman Sachs is closer at 15 to 16%, but Goldman doesn't have JP Morgan's consumer banking scale. That ROE premium is the core reason JP Morgan trades at a higher price-to-book multiple than any of its peers.
On pure valuation, JP Morgan at 14.1 times earnings, Bank of America at 14 times, Wells Fargo at 13.8, Goldman at 15.8, relatively tightly clustered, but the earnings quality and consistency are meaningfully different.
The Wells Fargo wildcard is worth noting. WFC has been operating under a Federal Reserve asset cap since the fake account scandal of 2016. That cap has severely limited the bank's ability to grow. The expectation, widely shared by analysts, is that the Fed will lift that cap in 2026, which would allow Wells Fargo to deploy its capital more freely. If that happens, WFC could be the most re-ratable bank stock in the sector. It's the one peer scenario where a competitor could genuinely change the competitive dynamics JP Morgan faces.
Options traders are moderately bullish on JP Morgan. Put-to-call ratio at 0.71, reflecting more bullish bets than bearish ones. Implied volatility at the 42nd percentile, not particularly elevated, suggesting the market is not pricing in extreme uncertainty.
Call concentration at 300 and 320 implies traders are positioned for a return toward record territory. Put protection at 260 and 240 suggests institutions are hedging against further macro-driven downside. With the April 11th earnings report just 4 days away, options activity is worth watching closely for any unusual positioning ahead of what could be a significant market-moving event.
Insider activity is net selling, primarily pre-planned transactions. 5 sells over the last 90 days, totaling approximately $22 million, with 0 purchases.
The notable context. Jamie Dimon himself made his first significant stock sale in 20 years in early 2025, selling approximately $150 million in JP Morgan shares. He cited personal financial diversification. The fact that it was his first sale in 2 decades tells you something about his historical conviction in the stock. But the sale itself is naturally noticed.
Dimon still holds approximately $1.8 billion in JP Morgan stock. He is deeply aligned with shareholders. But the sale is a data point, and it's one that bears note. The key catalyst is April 11th, Q1 2026 earnings. In the next 4 days, we'll know. Is investment banking fee growth actually running at mid to high teens as guided? Is net interest income holding up? What's the credit quality trend in consumer cards and commercial real estate? And will Dimon say anything about succession?
The structural risks. First, credit cycle risk. JP Morgan has built reserve buffers, but a genuine recession, which some economists assign 35% probability in 2026, would be painful. Second, interest rate risk. Every 50 basis points of unexpected Fed cuts costs JP Morgan roughly $2 billion in annual NII. Third, regulatory action on credit cards. Fourth, Dimon succession.
The metrics to track: ROTC, which management targets at 17%, net interest margin trajectory, investment banking fee revenue growth, and any updates on the share buyback authorization. JPMorgan Chase, in 2026, the world's most capable financial institution, with the most respected CEO in banking, the best-in-class returns, the deepest technology investment, and a franchise that has gotten stronger in every economic environment of the past 2 decades. The financial health is exceptional.
The bull case says 14 times earnings is cheap for a bank earning 17.8% ROE with a $1 trillion wealth management business and an investment banking franchise that's about to see 2 years of pent-up deal flow close. The AI operating leverage hasn't even begun to show up in efficiency ratios.
The bear case says recession risk is real. The diamond premium will eventually become a diamond discount. NEM is under pressure, and credit cards face both regulatory and credit quality headwinds simultaneously.
The key metric to watch, ROTC. If JPMorgan can hold return on tangible common equity above 17% through a rate-cutting cycle while managing credit losses below historical cycle highs, the stock has significant upside from current levels.
Jamie Dimon famously said, "Risk management is the most important thing to be good at in banking." He wrote that in one of his annual shareholder letters at a time when most of his competitors were underestimating risk and chasing yield. The result of getting that right consistently over 21 years is a $4.5 trillion fortress that came through the worst financial crisis in modern history without a single quarterly loss.
The question for the next decade of JPMorgan isn't whether the franchise is great. It is. The question is, who runs it after Dimon, and whether they can maintain what he built.
That's going to do it for episode 62 of Charged Alpha, the S&P 500 stock encyclopedia. JPMorgan Chase, from Aaron Burr's Manhattan Bank in 1799 to the most powerful financial institution in American history. We hope it gave you a cleaner view of the fortress on Wall Street. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. Check it out. Until then, I'm Hudson Thomas.
And I'm Lana Chen. This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street